In the previous video on Follow My Rules or Lose Everything, I told you that a trader without discipline is like a ship without a compass. Now, let's take that a step further. Because discipline means nothing if you don't know what you're looking at on the chart. You can be the most patient man alive, but if you can't read market structure, if you can't see where the real pressure is building, then you're standing in the middle of the battlefield with your eyes closed. And that, my friend, is how you get taken out before the real move even begins. Let's talk about the art of reading market structure for a breakout. Not guessing, not hoping, not gambling, but reading. Because the market always tells its story if you know how to listen. The crowd sees chaos, but the trained eye sees rhythm, formation, intention. Every high and low, every retracement is the tape talking. And if you can read it right, you can spot when the market is preparing to break its boundaries. Ask yourself this: how many times have you watched a chart move sideways, convinced that it's going nowhere, only to see it explode right after you've lost patience and walked away? That's not bad luck. That's unread structure. The market was whispering the whole time, "I'm getting ready." But you didn't hear it. A market in consolidation is like a coiled spring. Prices building energy, shaking out the weak hands, cleaning up the stops. I used to sit and watch that kind of price action for days, sometimes weeks. I didn't mind waiting. You see, the money isn't made by doing something every minute. The money's made by doing the right thing at the right moment. Most traders can't wait. They chase every flicker, but the professional waits until the structure gives its signal, until price breaks with conviction, not noise. Now, when I talk about structure, I'm talking about the sequence of highs and lows, the swing points that define who's in control. When the market's making higher highs and higher lows, the buyers have the wheel. When it's making lower highs and lower lows, the sellers are steering. Simple. Yes, but not easy, because the crowd loves to overcomplicate what they don't understand. Here's what I do. I mark out the key levels. I watch where price gets rejected, where it finds footing, and how it behaves around those points. Then I wait for the story to unfold, because before every breakout, there's a test. A fake move, a shakeout, a trap. The market wants to see who's weak, who's emotional, who's trading with fear instead of patience. It's in that test that most traders lose their nerve. Tell me, have you ever entered a trade right before it reversed on you? Of course you have. We all have. That's the market teaching you to wait for confirmation. A breakout isn't real until it proves itself. The market has to show its hand. You want to see volume come in. You want to see follow through. You want to see that the crowd has finally joined the side you were quietly waiting for. That's when you move, not before. There's a funny thing about breakouts: they rarely happen cleanly. The market loves to deceive. You'll see a push above resistance, then a quick drop back below. That's a trap. It's meant to pull in the eager traders, the ones chasing excitement. But when the real breakout comes, it doesn't look flashy, it looks inevitable. The structure aligns, momentum builds, and you can almost feel that something's changed. That's not luck, that's recognition. And you know what's interesting? The patience to wait for that kind of clarity ties right back to what we talked about in Follow My Rules or Lose Everything. Because your rules are useless if you don't have the emotional strength to follow them. You might know exactly where the structure breaks, but if you can't hold your ground through the noise, the false moves, the boredom, you'll never catch the real move when it comes. I used to sit in my office watching tickers roll across the tape hour after hour. I didn't trade every move. I studied the behavior. I watched for the change of character the moment the market stopped making lower highs and started making equal ones. That's the shift before the storm. Most traders miss it because they're too busy trying to predict it instead of waiting to see it. Remember, prediction is vanity, confirmation is sanity. So, what does that look like on your chart? Picture this: price comes down, makes a low, bounces up, then returns to test that same low again, but this time, it doesn't break it. That's your clue. Buyers are stepping in. The structure is shifting. Then, when it takes out the recent high with momentum, That's your breakout structure forming. Now, you don't have to chase it, you just have to recognize it. And don't fool yourself into thinking that every breakout means a fortune. Sometimes, it's just the market stretching its legs before another nap. That's why context matters. The bigger the structure, the bigger the breakout. A range that's been building for weeks has more weight than one that's been forming for hours. It's all about the energy stored in the chart. Tell me, how many times have you jumped into a breakout only to watch it fail within minutes? That's because you didn't check the context. You saw price move, and your emotions moved with it. But the structure, if you'd really studied, it wasn't ready yet. The market rewards patience and punishes impulse. A good breakout, a real one, has alignment. The higher time frame supports the direction. The volume confirms the intent. The sentiment starts shifting. You can sense the market changing character before it actually moves. That's when you prepare, not when it's already halfway gone. You see, most traders want certainty before they act. They want guarantees. But the market doesn't deal in guarantees. It deals in probabilities. Your job is to read those probabilities from the structure and position yourself accordingly. The edge isn't in knowing what will happen, it's in knowing what's likely to happen and managing risk when it doesn't. And this is where the wealth-building mindset comes in. You don't make your fortune by catching every move, you make it by catching the right ones and preserving your capital in between. Because capital is your ammunition. Once it's gone, your opportunity's gone too. The man who protects his capital has the patience to wait for the best setups. The man who trades recklessly never gets to see the real breakouts because he's already out of the game. Now, remember something important: every market, every asset, every chart tells the same kind of story, it's just written in a different dialect. The footprints of accumulation, distribution, expansion, they're universal. You don't have to reinvent the wheel, you just have to learn to read it fluently. So, the next time you open your chart, don't stare at the candles hoping they'll tell you what to do. Study them like you'd study a person's face. Look for tension, hesitation, aggression. The market has moods, and structure is how those moods are expressed. Once you learn that language, you'll see the setups forming before most people even realize there's something brewing. Confirmation matters more than prediction. Every trader wants to know what's going to happen next. They want certainty in a world that's built on uncertainty. But that desire, that need to predict, is what ruins most of them. The truth is, the market doesn't reward prediction, it rewards observation. It rewards the man who waits for proof instead of the man who guesses. Because guessing is gambling, and confirmation is trading. You see, when I talk about confirmation, I'm not talking about waiting for someone else to tell you what to do. I'm talking about letting the market show you its hand. The tape never lies. Price always leaves clues. When a breakout begins, you can see it in the behavior of the candles, in the speed of movement, in the way price reacts to levels that once acted as barriers. The trader who understands this doesn't have to predict, he simply reads what's in front of him. Think about it. How many times have you seen a setup that looked perfect, a clean resistance level, a solid trend, everything lining up only for price to break out for a moment, then reverse sharply and stop you out? That's what happens when you trade prediction instead of confirmation. The market gave you a hint, not a commitment, and you jumped too soon. Confirmation is about waiting for the market to prove its direction. It's about seeing a breakout hold instead of just happen. When price breaks above resistance and then retests it as support, that's confirmation. When volume rises with the move, showing that participation is coming in, that's confirmation. When you see continuation instead of hesitation, that's confirmation. You're not reacting to a flash, you're reading a shift in sentiment. Ask yourself this: why are you in such a rush to be first? Do you think the market pays extra for early entries? It doesn't. It pays for accuracy, not for speed. The man who buys too soon gets trapped with the impatient crowd. The man who waits for proof trades alongside the professionals. Because real moves don't vanish in a minute, they build momentum, they gather volume, they confirm. I learned this the hard way years ago when I used to chase breakouts. I thought the first move was the real move. I wanted to be ahead of everyone. But the market humbled me. It taught me that the first breakout isn't always the real breakout. It's often a test, a trap, a way to shake out the weak hands. The second move, the one that follows confirmation, that's where the real money is. When you trade confirmation, you're aligning yourself with the flow of capital. Think about how large players move. They don't buy into resistance, they wait until that resistance is broken, retested, and proven to hold. Then they enter quietly while the crowd hesitates. They don't need to be first, they just need to be right. And that's what separates a professional from a speculator. In trading, prediction feeds your ego, but confirmation builds your account. The ego says, I called it. The professional says, I waited for it. Every chart tells the same story. If you watch long enough, you'll see that every major move had a period of hesitation first. That's where the impatient traders get chopped up. They see a breakout, they enter, and the market pulls back to test their conviction. Those who predicted without waiting get shaken out. Those who waited for confirmation are now stepping in while everyone else is panicking. The beauty of confirmation is that it turns trading into a game of patience rather than impulse. You're no longer reacting to every tick, you're observing structure, waiting for alignment. You stop trying to outguess the market and start letting the market lead you. And when you do that, everything changes. You trade less, but your trades mean more. You stop caring about being right every time, you only care about being right when it matters. Remember, the market has two kinds of moves, fake ones and real ones. The fake ones are built on emotion, the real ones are built on structure and participation. Confirmation helps you tell the difference. A fake move has no follow-through, it dies quickly. A real move has life, it continues, it builds. When price breaks a key level and holds above it with increasing activity, that's life. That's your sign. That's where the probabilities tilt in your favor. Do you know why most traders fail? Because they believe trading is about prediction. They think they can forecast every turn. But the truth is, no one knows where the market will go next, not me, not you, not the big institutions. What the pros know is how to react when the market reveals its intent. They wait for confirmation. They don't need to predict because they understand structure. When I studied the tape back in the day, I used to watch how the market absorbed orders around key levels. I didn't care what people said would happen, I cared what price did. If the market tested a level several times and then finally pushed through with strength, that was confirmation. That's when I acted. I didn't need to be the first tick above resistance. I needed to see that the crowd had shifted. And here's something most traders never grasp. Confirmation protects your capital. When you predict, you expose yourself to unnecessary risk. You're trying to be right before the market proves you are. But when you wait for confirmation, your probability of success rises because you're trading in alignment with what's already happening, not what you hope will happen. Now, confirmation doesn't mean perfection. It doesn't mean you'll never take a loss. It means you're filtering noise from signal. It means you're stacking the odds in your favor. That's the essence of trading, not certainty, but probability. When you combine confirmation with discipline, that's when you start trading like a professional. And that ties directly into your mindset as a trader. Because waiting for confirmation requires patience, restraint, and emotional control. It forces you to sit on your hands while everyone else is chasing shadows. It reminds you that this game isn't about excitement, it's about consistency. It's about reading the market's behavior, not forcing your expectations onto it. So the next time you see price break out, don't rush to predict the end of the move. Watch how it behaves after the breakout. See if it can hold above that level. See if the volume supports it. See if structure aligns across time frames. That's your confirmation. That's where the smart money moves. Because the market always confirms before it commits. Structure reveals intention, price action tells the market's true story. That's something I learned after years of watching the tape roll across my desk, day after day. You see, the market never speaks directly, but it always tells the truth if you know how to read it. Every move, every candle, every tick has a reason behind it. And when you understand the structure, you understand that reason. Most traders are too busy chasing indicators or looking for shortcuts, but the real secret is written right there in the movement of price itself. The market is like a living thing. It breathes, it pauses, it attacks, it retreats. Structure is how it communicates its intentions. Ask yourself, why do you think the market forms patterns? Why do you see the same shapes repeating across years and time frames? It's because human behavior never changes. Fear and greed have the same fingerprints today that they did 100 years ago. Structure is the shadow those emotions cast on the chart. When you see higher highs forming, that's not just price, it's confidence, it's accumulation, it's demand overpowering supply. When you see lower lows, that's fear, liquidation, surrender. The story of the market is told through those simple sequences, over and over again. When you look at a chart, don't just see lines and candles. See the struggle underneath. The buyers and sellers are fighting for control, and each side leaves footprints. When buyers push up and get rejected, that rejection marks resistance. When sellers drive price down and it bounces, that bounce marks support. These levels, these structures, are where the market reveals its hand. A professional trader studies those reactions, like a detective studies clues. You don't need to predict what will happen, you only need to recognize what's already taking place. I used to say the market is never wrong. It's people who are wrong. And that's because most people look at the market emotionally, not structurally. They want it to move in their favor. They want confirmation of their beliefs. But the structure doesn't care what you believe, it only reflects what's actually happening. And once you strip away emotion and see price for what it is, a record of collective psychology, you begin to trade differently. You stop forcing trades and start aligning with the flow. Think about how structure forms. First, there's accumulation, a quiet phase where the big players are buying while the public is still asleep. Then comes markup, price begins to rise as more traders notice the movement. After that, there's distribution, the professionals are selling to the latecomers. Finally, markdown, the price falls as the crowd realizes too late what happened. This cycle repeats endlessly across all time frames, and if you can spot where you are in that structure, you already have the edge. Have you ever wondered why price tends to revisit the same zones again and again? It's because structure builds memory. Those levels represent emotional scars in the marketplaces where traders took heavy losses or missed opportunities. When price returns, those emotions return with it. Some traders will bail out, others will try to make up for the past. That behavior creates reaction points, and those reaction points are where you can see the market's true intention. A lot of traders make the mistake of thinking the market moves randomly. But if it were random, why would we keep seeing the same patterns, flags, triangles, ranges, trends? The truth is, structure reveals the rhythm of the market. It's not chaos, it's psychology organized in price. The higher highs and higher lows of an uptrend are confidence growing. The lower highs and lower lows of a downtrend are confidence collapsing. When the structure changes, when a trend fails to make a new high, that's your clue momentum is shifting. The smart trader notices that before everyone else. Do you see now why price action tells the real story? Indicators are lagging, they tell you what's already happened. But structure, pure price, shows you the decision being made right now. When price consolidates, it's the market catching its breath. When it breaks out, it's the market declaring direction. Every phase has meaning, and each transition has opportunity. Back when I traded on the floor, I didn't have fancy screens or indicators. I had the tape, and that was enough, because the tape showed structure in motion. You could feel when the market was preparing for a breakout. You could sense when accumulation was turning into markup. That came from studying how price behaved, not what someone's theory said it should do. Once you understand structure, you don't need predictions. You just need patience and observation. Structure also reveals the strength of the participants. For instance, when price breaks a high but immediately falls back below it, that's a sign the breakout wasn't supported by real demand. But when price breaks a high and stays there, consolidating just above it, that's strength, that's conviction. Those subtle differences are what separate a false move from a real one. Most traders don't see that because they're looking for instant results instead of studying the story price is telling. And here's the thing, structure is the only constant across all markets. Stocks, forex, commodities, crypto, it doesn't matter. The structure is universal because human behavior is universal. The patterns you see on a 1-minute chart also appear on a monthly chart. It's the same psychology, just stretched or compressed in time. Once you train your eyes to recognize it, you can trade any market, any time frame. The market structure also teaches you humility, because sometimes the structure is clear and other times it's messy. That's the market's way of telling you to stay out. You don't need to force clarity where there is none. Waiting for structure to form is just as important as reading it. That patience separates a trader from a gambler. Ask yourself when you look at a chart, do you see opportunity or confusion? If it's confusion, that's fine. That means the story isn't finished yet. The structure is still being written. The best trades come to those who wait until the narrative becomes clear. When the market shows higher lows pressing against a ceiling, you know pressure is building. When that ceiling finally breaks with conviction, that's intention revealed. Structure doesn't just tell you where to enter, it tells you where not to. It shows you where traps lie, where emotions are high, and where value is shifting. Once you understand that, trading becomes less about guessing and more about following logic. Because structure isn't opinion, it's evidence. It's the footprint of money moving from one hand to another. That's why I always say, the market doesn't need to be predicted, it just needs to be read. And structure is the language it speaks. Every peak, every valley, every range is a word in that language. Learn to read it, and the noise disappears. You stop hearing rumors, tips, and predictions, and you start hearing the market itself. Higher highs and higher lows define control, not indicators. Every chart you'll ever see is just a reflection of that one simple truth. The market moves in waves up, down, and sideways, and those waves tell you who's in command, the buyers or the sellers. You don't need a fancy indicator to tell you that. You don't need 10 screens of data or a new algorithm. You only need to read the rhythm of price itself. Because when the market's making higher highs and higher lows, buyers are winning the battle. When it's making lower highs and lower lows, sellers are in charge. That's all there is to it. Everything else is noise. Now, I know what you might be thinking, it can't be that simple. But simplicity is what the crowd ignores because it doesn't look sophisticated enough. Yet the market rewards clarity, not complexity. Every higher high tells you demand is strong enough to overcome supply. Every higher low tells you buyers are stepping in sooner than before, unwilling to let price fall as far. That pattern is the heartbeat of an uptrend. It's not a guess, it's confirmation that control belongs to the bulls. Ask yourself, how many times have you missed a good move because you were waiting for an indicator to confirm what the naked eye could already see? The truth is, indicators follow price. They're delayed by design. But the market structure speaks in real time. When you watch the price make a new high and then pull back without breaking the previous low, that's strength. That's demand showing its hand. You don't have to predict where the next candle will land, you just have to follow the rhythm of those highs and lows. When I started out, I used to clutter my charts with every tool imaginable. I wanted precision, I wanted certainty. But all that noise blinded me to the only thing that mattered, the progression of price. Once I stripped my charts bare and focused on structure, everything changed. The story became clear. I could see when momentum was building and when it was fading. I could see when control shifted from one side to the other. That's when I realized higher highs and higher lows aren't just patterns. They're the footprints of conviction. Let's say the market has been trending up. You see it push to a new high, then pull back to make a higher low. That low is critical, it's where the buyers defend their ground. If price holds above the previous swing low, the structure stays intact, and the trend remains healthy. When that higher low leads to another higher high, You have confirmation that buyers are still in control. It's simple, mechanical, and logical. You don't need opinions. You only need to follow what price is doing. But what happens when the market fails to make a new high? What if that next push stalls or reverses? That's your first clue that control is slipping. The higher high didn't form because buying pressure weakened. The next low might come in lower than before, and suddenly the sequence shifts. That's your warning. That's how you spot a change in control before the crowd sees it. You're not relying on a signal, you're reading the story as it unfolds. You see, this kind of observation takes patience. Most traders don't want to wait for the structure to confirm itself. They want to anticipate. They want to predict the next high or low before it forms. But anticipation is dangerous. The pros don't anticipate, they react. They let the market declare who's in charge, and then they follow that side. That's what trading is about, aligning with strength, not fighting against it. Do you know why so many traders lose in trending markets? Because they keep fighting the trend. They look at a strong series of higher highs and higher lows and think, it's gone too far, it must reverse soon. They step in front of a train because their ego wants to be right instead of profitable. But structure doesn't lie. As long as that sequence holds, buyers are in control. Trying to call the top before the structure breaks is just wishful thinking. This approach also teaches you discipline. You don't buy just because price moves up once. You wait for a pattern, a higher high followed by a higher low. You wait for confirmation that demand has stepped in twice. That's not gambling, that's strategy. You're letting the market prove itself before committing your capital. The same goes for downtrends. Lower highs and lower lows confirm that sellers are in control. Every rally is just a pause before another leg down. There's something powerful about seeing control on a chart. You start to think differently. Instead of reacting emotionally to every move, you read the transitions calmly. When the market's rising, you focus on buying pullbacks instead of shorting spikes. When it's falling, you sell rallies instead of trying to catch bottoms. That shift in thinking from emotional reaction to structural observation is what separates a trader from a gambler. Now, the real beauty of this principle is how universal it is. It works on every market and every time frame. Whether you're trading the daily chart of a stock or the 1-minute chart of a currency pair, structure always tells the same story. If you zoom in or out, the rhythm doesn't change, only the scale does. That's why professionals can adapt so easily. They don't memorize setups, they understand control. I remember watching the market in the early days, seeing it grind higher and higher, and thinking it had to fall soon. But the structure never broke. Each dip was bought, each retracement shallower than the last. That's what control looks like. The market was showing strength, and I finally learned to stop guessing and start following. Once you learn to recognize control, you stop trying to outsmart the market. You start flowing with it. Ask yourself, are you trading with control or against it? If you can't answer that, you're not reading structure. Because control isn't hidden, it's written in every swing. The buyers and sellers are constantly leaving clues. You just have to notice which side is making progress and which side is failing. When buyers keep pushing price to new highs, they're showing persistence. When sellers fail to drive price below previous lows, they're showing weakness. The chart is telling you who's winning long before the headlines do. When you strip away all the noise, all the opinions, what's left is structure. That's the purest form of truth the market offers. It doesn't need interpretation. It doesn't care about predictions. It just tells you, in its own language, who holds the reins. Higher highs and higher lows, simple, yes, but that simplicity holds more power than any system or indicator ever could. Because once you learn to read who's in control, you stop trying to be right, you start learning how to trade with what's real. Consolidation is energy, breakouts are the release. That's one of the truest lessons the market will ever teach you. Every time the price stops moving in a clear direction and starts moving sideways, it's not because the market has forgotten where it's going. It's because it's building strength for the next move. The market is like a coiled spring, it tightens, it compresses, and when the time comes, it snaps. That snapping point is the breakout, the release of stored energy that's been gathering quietly while most traders grow impatient and lose focus. You've seen it happen, haven't you? Price runs hard in one direction, then suddenly stalls. It moves in a narrow range, back and forth, like it's taking a breath. Traders call it boring, untradeable, slow. But that's when the market is whispering its next big secret. Every candle, every rejection, every test of that range is part of a build-up. The smart trader watches closely during that time, because consolidation always comes before expansion. It's nature's rhythm compression before explosion. Ask yourself, how many times have you exited a trade too early because you got bored watching sideways movement, only to see the market break out right after you left? That's not bad luck. That's lack of patience. The professional doesn't see consolidation as dead time. He sees it as potential time. That's when he's studying structure, marking levels, and preparing. Because once that energy is released, the market moves fast, and only the prepared can catch it. The longer the consolidation, the bigger the move that follows.